Okay, let's unpack this. Have you ever found yourself wondering about the invisible ballet that goes on behind the scenes?
Mm.
To make sure a company's shelves are always stocked or that what they claim to have in inventory actually is there, ready for you to buy.
It seems simple on the surface, doesn't it? Just having stuff.
Exactly. It sounds like a simple question, right? But the answer, the actual process, well, it's far from simple.
Yeah,
Yet it's absolutely critical to a business's very survival and, its ability to serve you.
absolutely critical.
Today, we're embarking on a fascinating deep dive into something called the inventory cycle.
Mm.
And look, this isn't just some dry accounting term. It's a fundamental, really dynamic process for almost any company that, creates, buys, or sells physical product.
Pretty much anything tangible.
Yeah, whether it's the sneakers you wear, the groceries in your fridge, or the components in your smartphone, they all pass through this really intricate cycle.
Everything.
Understanding it gives you a real shortcut to seeing how businesses truly operate, how they protect their most valuable assets, and critically, how they're verified for accuracy by independent eyes.
That verification piece is key.
We're going to pull back the curtain on the crucial internal controls and the rigorous auditing procedures that ensure this entire system doesn't just fall apart, protecting both the company and ultimately you, the consumer.
What's truly fascinating here, I think, is the sheer amount of precision and planning and, well, underlying trust that goes into something as seemingly straightforward as just having stuff to sell.
Right. It's not just counting boxes.
No, not at all. It's
Yeah.
much more than that. It's a meticulously choreographed symphony of internal controls and rigorous verification steps.
A symphony. I like that.
Yeah. Imagine the complexity. Every single item from, say, a tiny microchip to a massive piece of heavy machinery needs to be accounted for. Not just physically present, mind you, but also accurately recorded on paper or, in the system.
And the stakes are huge.
Oh, incredibly high. Because for many businesses, inventory represents a significant chunk, often the largest portion, of a company's assets,
Directly hitting the bottom line.
directly impacting its profitability and its basic ability to function. Without a really robust system, that value could, well, it could simply vanish. Poof.
Okay, so let's kick things off with the foundation then. Before a company can even think about selling anything or, an auditor can start checking things.
Right, before any of that
A
happens.
business needs to establish an incredibly robust system. Think of it as maybe the core operating system for all its goods.
That's a good way to put it.
The foundational rules, the non-negotiable blueprint for how inventory moves into, through, and ultimately out of the business. We're talking about internal controls specifically designed for the inventory cycle.
Mm.
So why are these controls so unbelievably crucial?
Mm-hmm.
Why can't a company just, well, wing it and hope for the best?
That's a crucial question because the consequences of winging it, as you say, can be, well, severe. The core idea behind strong internal controls for inventory is really twofold. First, the adequate safeguarding of the inventory itself, physically protecting it from loss, damage, or theft.
Just keeping it safe.
Exactly. And second, proper segregation of duties among employees, which basically prevents any single person from having too much power or responsibility over a process.
Segregation of duties. We'll get into that.
We will.
Yeah.
But imagine, let's picture a massive warehouse, right? Bustling with activity, full of goods worth maybe millions.
Okay.
Without these controls, that valuable inventory is highly vulnerable. It could be easily lost, stolen, miscounted.
Or even just valued incorrectly on the books.
Precisely. Incorrectly valued. Any one of those issues, or heaven forbid, a combination, can quickly lead to enormous financial problems for the company.
Yeah, I could see that.
Think about misrepresentations on a company's financial statements. That can mislead investors, banks, anyone relying on those numbers. Ultimately, it can cripple a company's ability to serve its customers reliably. I mean, if a company doesn't have accurate, trustworthy inventory records, how can it possibly promise delivery dates?
Right. Or fulfill online orders.
Exactly. How can it even plan what to produce next? It simply can't function effectively.
It sounds like chaos waiting to happen.
It really is. It's like trying to run a high-volume, maybe a Michelin-star kitchen, where everyone just does everything. Ordering ingredients, receiving them, storing them, cooking every single dish, and maybe even handling all the billing, too.
Total chaos.
It would be absolute chaos. Ingredients would go missing, dishes would be inconsistent, money would disappear. It just wouldn't work.
That kitchen analogy really makes it clear. So the whole idea is to prevent that chaos, that potential single point of failure.
Precisely.
And that brings us to where it gets really interesting and crucial. One of the most vital control mechanisms you just hinted at, something called segregation of duties. It sounds a bit formal, maybe even bureaucratic, but you're saying in practice, it's remarkably simple and incredibly powerful.
It really is.
It's all about making sure no single person has too much control over a process from, start to finish. Why is this such a monumental deal for inventory, specifically, and how does it actually play out in the real world, to prevent errors or even outright fraud?
It's a monumental deal because it acts as this sort of invisible system of checks and balances.
Okay.
By strategically dividing responsibilities, you make it exponentially harder for a single individual to commit significant errors or engage in fraudulent activities without someone else in the process detecting it, or at least having the opportunity to detect it.
Creates layers.
Exactly. It creates layers of accountability. In the inventory cycle, this is meticulously played out across several distinct departments. Each one has a very specific, limited, yet absolutely crucial role.
Okay, so break that down for us. What are these departments?
All right, first up, we have the purchasing department. Their role is the very first step, initiating the acquisition of goods the company needs.
The ones doing the buying.
Right. The key control here is the careful preparation and issuance of what we call serially numbered, properly approved purchase orders.
Serially numbered, you mentioned that's important.
Very important. Serially numbered isn't just a fancy term. It means each purchase order has a unique sequential number, like the checks in your checkbook.
Ah, okay. Makes sense.
This simple detail is surprisingly powerful because it makes it incredibly difficult for orders to go missing, be duplicated, or even be faked.
So you can track every single one.
You can track every single one. These approved orders are then sent to various departments, including accounting and receiving. The fundamental purpose of this control is to ensure that all purchases are genuinely authorized and fully traceable. It's the first line of defense against unauthorized buying or maybe the creation of fictitious purchases, which someone could use to siphon off funds or, create the illusion of inventory that doesn't actually exist.
Right, phantom inventory.
Exactly. You can literally track every single order from its inception right through to its delivery.
Okay, so that's purchasing. What's next?
Next in line is the receiving department. This is the company's front line for incoming goods, the first physical point of contact.
Where the stuff actually arrives.
Precisely. Their key responsibilities are very specific. Accurate verification of quantities received against what was ordered.
Checking the count.
Checking the count. Meticulous detection of any damaged goods upon arrival.
Looking for problems.
Right. Then the preparation of a formal receiving report, which is essentially a detailed record of exactly what arrived and in what condition. And finally, the secure delivery of these goods to the warehouse.
Now, here's a crucial detail I read about that seems like a real aha moment for many people. The receiving department should intentionally receive a copy of the purchase order that does not indicate the quantity ordered.
That's correct. It's often called a blind copy or blind receiving.
Okay, blind copy. But this raises an important question. Why? Why would they intentionally hide the quantity from the receiving department? Wouldn't that just make their job harder or more prone to mistakes? Or slow them down?
But that's the brilliance of the control. It seems counterintuitive, I know.
It does.
But it's designed to achieve precisely the opposite effect. By withholding the quantity that was ordered, the receiving department is essentially forced to perform an independent, unbiased, physical count of the goods upon arrival.
They have to count it themselves.
They have to count it. They can't just glance at the packaging, see the supplier's manifest, or just assume the quantity is correct based on what should have been sent.
No shortcuts.
No shortcuts. This prevents assumptions, drastically reduces the chance of errors in counting due to, say, negligence, and ensures that any discrepancies, shortages, overages between what was ordered and what was actually received are detected early, right at the point of entry.
Catches problems immediately.
Immediately. It pushes for true accuracy and accountability from the very first physical touch point. Imagine a shipment comes in and the receiving clerk is just, ticking boxes without really counting.
Yeah.
If there's a shortage, the company might not know until much later, maybe even after they've paid the supplier.
Making it hard to fix.
Exactly. Much harder to claim from the supplier. This control catches it right away.
Okay, that makes perfect sense now. So after receiving verifies everything.
Once the goods are properly received and verified, they move to the warehouse department.
Okay.
This department acts as the physical custodian for that verified quantity of goods. Their key function is the meticulous physical safeguarding of the inventory and maintaining its integrity.
Keeping it safe and sound.
Right. Ensuring it's stored correctly, protected from damage, spoilage, or theft, and that records of its exact location and movement within the warehouse are meticulously kept.
And this department is separate from the others.
Yes, intentionally kept separate from purchasing and receiving. Why? Well, to prevent the very people who order or receive goods from also being solely in charge of their long-term storage and movement.
Another layer of control.
Another layer. This separation significantly reduces opportunities for unauthorized removal, theft, or even just misplacement, as two different sets of eyes, or rather two different departments, are involved with the inventory at different critical stages. It's a fundamental principle of trust and verification.
Makes sense. Okay, what's the final piece of this puzzle?
Finally, we arrive at the shipping department. This department is responsible for getting the goods out of the company and into the hands of customers.
The outward journey.
Exactly. A critical internal control here is that shipment only occurs after proper authorization. This authorization typically comes in the form of an approved sales order, which often includes a credit approval from the credit department.
So they check if the customer is okay to ship to.
Precisely. They ensure that goods are only shipped to legitimate customers who have been vetted and approved for credit, meaning they're likely to pay their bills.
Prevents shipping stuff out for free, essentially.
Or shipping to fake customers. This prevents unauthorized shipments that could lead to uncollectible revenue or even, fictitious sales recorded just to inflate a company's reported performance.
Wow.
Each and every step in this chain, purchasing, receiving, warehouse shipping, is carefully designed so that one department's action is checked and balanced by another's. It builds this sophisticated layered defense against both errors and deliberate fraud.
So what this all really means then is that the inventory cycle isn't just a series of isolated tasks. It's, like you said, a careful, intricate dance.
It really is.
Where each department acts as an essential check on the other. It's like building a strong, multi-layered fortress wall against errors or fraud, where no single brick can bring the whole structure down.
That's a great analogy.
It's truly fascinating how this design protects a company's most valuable assets, ensuring reliability not just for the business itself, but ultimately for you, the customer, who relies on that business having what it says it has. It's not just about a dry set of rules. It's about designing a dynamic process where human nature's potential for oversight or carelessness or even, malfeasance is actively mitigated by the very structure of the work itself.
Well put.
Now, okay, even with the most impeccably designed internal controls, like the ones you just described.
Right, even with the best system.
Companies need an independent, objective check to ensure everything is actually running as it should be and that the financial statements they present to the public truly reflect reality.
The verification step.
This, of course, is where the external audit comes in. And within that audit, one of the most critical areas is auditing the inventory balance. A huge part of this, I gather, is the physical inventory count.
Yes.
Why is it so absolutely crucial for an independent auditor to be involved in this, hands-on physical verification?
You've hit on perhaps the most visible and honestly often misunderstood aspect of inventory auditing.
Okay.
It's absolutely critical because the observation of both the beginning and ending physical inventory counts is a required, generally accepted auditing procedure.
Required, not optional.
Not optional. Let me emphasize that.
Yeah.
It's not optional. It's a fundamental, non-negotiable part of providing an independent, credible opinion on a company's financial statements. If inventory is material, you generally have to observe it.
Right. Okay. So it's required. But what does observation actually mean here?
Good question.
Yeah.
Because here's a common misconception that even, many people in finance might hold. When you hear inventory observation, you might picture the auditor arriving with a clipboard and personally counting every last screw, every sweater, every car in the client's warehouse.
Yeah, that's kind of what I picture.
Right. But that's not their role at all. That's simply not the case. The client, the company itself, counts the inventory.
The company does the counting.
Yes. The auditor's role is to observe the client's counting process. Think of them more like a quality control inspector overseeing the assembly line, rather than being one of the workers actually putting the parts together.
Okay, that distinction is important.
Very important. While the auditor may make test counts of certain items, selecting a small random sample and counting them independently to compare against the client's count, they generally would not, and frankly cannot, count the client's entire inventory.
Just not feasible.
Not feasible, and not the objective. Their job is to ensure the process the client uses is sound and reliable, and that the results coming out of that process can be trusted.
Ah, that makes a lot of sense. It really highlights the auditor's role as this skeptical, independent verifier, ensuring the system works, rather than being the person performing the, let's face it, tedious task of counting everything.
Exactly. Skeptical verification is the name of the game.
So if they're not counting everything themselves, what are they actually doing during this observation? What are these dual-purpose tests that you mentioned? What do those actually involve?
That's an excellent question, because what they do during that observation is actually quite comprehensive, and these actions often serve multiple audit objectives simultaneously, hence the term dual purpose.
Okay.
First, they are meticulously evaluating management's instructions and procedures for the inventory count. Before a single box is even moved, management should have a detailed written plan.
The game plan for the count.
Exactly. The auditor reviews this plan. How will items be identified? How will they be counted? And by whom? How will count tags be controlled and recorded? The auditor scrutinizes this plan to ensure it's robust, well thought out, and adequate to achieve an accurate and reliable count.
Checking the instructions first.
Right. If the plan itself is flawed, the outcome, the count itself, will likely be flawed too.
Makes sense. What's next?
Second, and this is where the observation truly comes into play, they are observing the actual performance of management's count procedures.
Watching the count happen.
Watching it happen, often for hours or even days, depending on the scale. Are employees actually following the instructions laid out in the plan? Are they being thorough and systematic, or are they rushing through, maybe skipping steps, making assumptions?
Looking for shortcuts or sloppiness.
Exactly. Are two people counting each section as planned? Or is just one person maybe haphazardly ticking off items? The auditor is looking for deviations from the plan, signs of sloppiness, or potential shortcuts. This direct, real-time observation provides incredibly strong evidence about the reliability of the client's counting process.
You can really see if they're doing it right.
You can. If they see workers just, say, eyeballing boxes rather than opening them and actually counting the contents, that's a major red flag.
Okay, so evaluating the plan, observing the process. What else?
Third, they are actively inspecting the inventory to ascertain its existence and condition. As they walk through the warehouse or the store, the auditor isn't just passively watching the count, they're actively looking at the inventory itself.
Getting eyes on the actual goods.
Yes. Is it physically there? Are the items clearly identifiable and accurately described on the count tags? And crucially, what condition is it in? Are there signs of damage, spoilage, or obsolescence?
Like dust-covered boxes in the corner.
Exactly. Or, for example, if they're auditing a food distributor and they spot pallets of produce that clearly look past their prime.
Right.
Or they're at a tech company and see boxes of outdated electronics like old CRT monitors gathering dust.
Stuff nobody wants anymore.
Right. These are major indicators of potential obsolescence that would require the inventory to be written down to a lower value. This helps ensure that what's being counted is not only physically present, but also still has economic value.
That's critical for the valuation.
Absolutely. And fourth, they are performing those crucial test counts. This is where the auditor does get hands-on, but with a small, carefully selected sample.
The spot checks.
The spot checks. They might randomly pick a few items from a shelf, count them themselves, and then compare their count to the client's recorded count on the inventory tags. This directly verifies the accuracy of a portion of the client's counting process.
Comparing notes, basically.
Exactly. They also perform what's called a floor-to-sheet test, picking an item from the warehouse floor and checking if it's included on the client's inventory listing sheets.
Making sure what's there is recorded.
Correct. And the opposite, a sheet-to-floor test, picking an item from the client's inventory listing sheets and then physically locating and verifying it in the warehouse.
Making sure what's recorded is actually there.
Precisely. These test counts provide direct evidence of both the existence and the accuracy of the count for those items. It's like a targeted confirmation, verifying that the client's internal controls over the count are truly effective in practice.
Okay, so that's the ideal scenario. The auditor present, observing, evaluating, inspecting, and test counting. the business world isn't always ideal.
Rarely is.
What if it's genuinely impractical to observe the physical inventory count right at year-end? Are there exceptions, maybe different timings, or alternative procedures for this observation? Especially for businesses with incredibly complex inventory operations, or maybe inventories spread across like dozens of locations.
Yes, absolutely. There are certainly nuances regarding timing and location that auditors deal with regularly. Generally, if it's genuinely impractical or perhaps impossible for the auditor to observe the physical inventory count, or if the inventories themselves are simply not material to the financial statements.
Meaning not significant enough to matter.
Exactly. If the value of the inventory is so small that even if it were completely misstated, it wouldn't significantly mislead a user of the financial statements. In those cases, alternative procedures are acceptable.
But usually inventory is material, right?
For most manufacturing, retail, or distribution companies, yes, inventory is a very material asset, so observation is almost always critical.
Okay. So what about timing? Can they do it earlier or later?
They can, under certain conditions, if a company maintains a very well-kept perpetual inventory system.
You mentioned the continuous tracking.
Right, a system where inventory records are continuously updated with every single purchase and sale, providing essentially a real-time balance, and if they also perform regular physical cycle counts throughout the year to ensure the system's accuracy.
What are cycle counts again?
Cycle counts mean they don't count everything all at once at year-end. Instead, they count small portions of their inventory on a rotating basis throughout the year, maybe count Section A this week, Section B next week, and so on.
Spreading the work out.
Exactly. Think of it like auditing a bookstore that scans every single book coming in and out. And then maybe every week, they physically count a different section of their shelves just to make sure the digital system count matches the physical reality.
Okay.
If a company has both a strong perpetual system and reliable cycle counts, then the auditor may observe the inventory before or after the actual year-end date.
So there's flexibility if the internal system is trustworthy.
Precisely. But there's a crucial follow-up here. If the auditor observes inventory at a date other than the financial statement date, let's say they observe a count in November for a December 31st year-end,
Right.
they then must obtain sufficient evidence about whether the changes in inventory between that count date November and the actual financial statement date December 31st are properly recorded.
They have to bridge the gap.
They have to bridge the gap. This involved meticulously auditing all the transactions, sales, purchases, returns, movements that occurred in that interim period. It's called performing roll forward or roll back procedures to reconcile the observed count to the year-end balance.
Okay, that makes sense. But what if the internal controls aren't strong?
Good point. There's a strong caveat here. If the assessed level of control risk is high, meaning the internal controls we discussed earlier are weak, unreliable, or maybe not consistently applied, then the observation procedures must be performed at year-end.
No exceptions then.
No exceptions. If we connect this to the bigger picture, high-risk demand, real-time, direct verification. You simply can't rely on the company's internal system or records if you don't trust them sufficiently. The observation needs to happen when it counts most at the balance sheet date.
Got it. High risk equals year-end observation. What about inventory that's not even on the company's premises, like off-site?
Right, off-site inventory. This could be goods held in public warehouses or goods out on consignment, meaning your client's products are being held and sold by another company or vice versa.
Okay.
The auditor should ideally observe the physical inventory count at those locations if that inventory is significant, meaning material, to the company's overall financial picture.
So if it's a lot of stuff, they should try to go see it.
Exactly. For example, if a car manufacturer has thousands of cars stored at a port awaiting shipment, that's significant. They should probably go observe. But if the amount held off-site is not significant,
Then what?
then simply obtaining a confirmation of the inventory directly from the third party holding it is usually sufficient.
A confirmation. Like a letter.
Yes, typically a formal written confirmation requested by the auditor directly from the independent warehouse or the consignee. It asks them to confirm exactly what inventory they hold on behalf of the client as of the year-end date. This adds an important external layer of verification.
Okay, so observation, test counts, confirmations. This is where it gets really granular, right? Really detailed. How do all these procedures actually tie back to ensuring the company's inventory numbers are reliable across all the different angles and claims they make? We're talking about audit assertions, which I understand are these fundamental claims management makes about their financial statements. What exactly are these assertions for inventory, and how does the auditor's meticulous work during the count address each one?
That's a fundamental bridge in auditing, absolutely. Audit assertions are, just as you said, the explicit or implicit claims that a company's management makes about the recognition, measurement, presentation, and disclosure of financial information in their statements.
The things they're claiming are true.
Essentially, yes. The auditor's job is to gather enough appropriate evidence to either support or refute these claims. For inventory, several key assertions are absolutely crucial to get right.
Yeah, like what?
Let's start with completeness.
Yeah.
This assertion basically means that all inventory that should be recorded is recorded. Nothing is left out, whether by accident or, on purpose.
Making sure everything's included.
Everything that belongs there. The auditor addresses this during observation by, for instance, tracing their own test counts, those items they physically counted themselves back to the client's official physical inventory report or listing.
Checking their sample got recorded.
Exactly. This ensures that the items they physically verified are indeed included in the formal records. They also take a sample of the pre-numbered inventory tags used during the count. Remember those unique numbers?
Yeah, from purchasing and using the count, too.
Right. They trace those selected tags to the physical inventory report sheets to ensure that all tags, which represent actual counted inventory items, are included and accounted for. Nothing has been accidentally or deliberately omitted from the final tally. If a tag is missing or can't be traced, that's a red flag for completeness.
Okay, completeness. What else?
Next up is valuation, allocation, and accuracy. This is a big one. It asserts that inventory is recorded at the correct monetary amounts, it's properly allocated, for example, between raw materials, work in process, and finished goods, and all the calculations are accurate.
So the dollar value is right, and it's categorized correctly.
Precisely. The auditor performs several procedures here. First, and maybe most straightforwardly, they test the mathematical accuracy of the inventory report, footing the columns, checking the extensions, quantity times price, making sure the summaries add up correctly.
Checking the math.
They then reconcile that final inventory report total to the general ledger inventory counts, ensuring the physical count ultimately aligns with the main accounting records.
Okay. What else for valuation?
Second, they actively inquire about obsolete or damaged goods. They're looking for items that might have lost their value. They'll scan the company's perpetual inventory records, if they exist, looking for slow-moving items that haven't sold or been used in a long time.
Because slow-moving could mean obsolete.
Often, yes. It can indicate potential obsolescence or reduced market demand. And they are constantly alert during the physical observation for any visible signs of damage, spoilage, or obsolescence, like those dusty boxes we mentioned.
And why is finding obsolete stuff so critical again?
It raises an important question. Why is obsolescence so critical? Because worthless or damaged inventory needs to be written down to its true lower value, maybe even zero.
Right.
This write-down directly impacts a company's reported profit and its asset valuation on the balance sheet. Imagine a fashion retailer holding racks of last season's trendy clothes that are now deeply out of style.
Can't sell them for full price.
Exactly. They likely can't sell those at full price, if at all. If that old, effectively unsellable inventory is sitting on the books at its original cost, the company's assets and its earnings are artificially overstated. That's misleading to investors and lenders.
Okay, so checking for obsolescence is key. What else for valuation?
Third, to ensure the cost assigned is proper, the auditor will examine actual vendor invoices to confirm the precise cost of purchased inventory items.
Verifying the purchase price.
Yes, and for manufactured goods, it's more complex. They'll review direct labor rates paid to workers, test how the company calculates its standard overhead rates, like factory rent, utilities, and examine analyses of any variances between standard production costs and actual costs incurred.
So making sure the cost to make the products is right.
Correct. All these various costs, direct materials from invoices, direct labor, and manufacturing overhead, are the components that make up the cost of manufactured inventory. The auditor then takes this verified cost information and applies these prices and rates to a sample of inventory items to determine whether the inventory is valued appropriately according to accounting standards, like FIFO or LIFO, which we'll touch on later.
Wow, that's detailed.
It has to be. It ensures the cost assigned to each product on the balance sheet is accurate and verifiable, supporting the financial statements.
Okay, so completeness, valuation. What's next?
Then we have existence and occurrence. This assertion ensures that the inventory listed on the books actually exists physically, and that the underlying transactions that affected inventory levels, like purchases or sales, actually occurred and weren't fabricated.
Making sure it's real and the transactions happen.
Exactly. And the primary purpose of the auditor's observation of the client's inventory count is precisely to establish this assertion of existence.
That's the main reason they're watching the count.
It's a huge reason. During the observation, the auditor directly verifies the existence of items by locating and test counting them from the physical inventory report, the sheet-to-floor test we talked about.
Finding it in the warehouse.
Yes. And they also test the existence of items on the client's inventory report sheets by vouching a sample of items from the report back to the corresponding pre-numbered inventory tags or the physical items themselves. Vouching basically means taking an entry from the accounting record, like the inventory listing, and finding the original source document or the physical evidence that supports it.
Proving it's not just a phantom number on a page.
Exactly. Proving it's real.
Okay. And the last assertion for inventory.
Finally, there's rights and obligations. This assertion means the company actually owns the inventory recorded on its books and has properly accounted for any obligations related to it.
Ownership. That seems straightforward, but maybe it isn't.
It can be one of the trickier assertions, actually, because ownership isn't always immediately obvious just by looking at where the inventory is located.
How so?
Well, the auditor must ascertain that consigned inventory on hand. That is, inventory belonging to other parties, but physically in the company's possession, maybe for sale on their behalf.
Like an art gallery selling a painting for an artist.
Perfect example. That painting is excluded from the gallery's own inventory count because the gallery doesn't own it.
Okay, exclude what you don't own.
Right. Conversely, consign goods in the hands of consignees, meaning the company's own goods that are being held and sold by another party, maybe like a fashion brand whose clothes are sold in an independent boutique store.
The boutique is the consignee.
Right. Those clothes must be included in the fashion brand's inventory balances because the brand still legally owns them until they're sold by the boutique.
Include what you own, even if it's somewhere else.
Precisely. It's about legal title, not just physical location.
Okay. What else falls under rights and obligations?
The auditor also confirms that any inventory held off-site, like in those public warehouses, is properly accounted for at year-end again, through observation if significant or external confirmation if not.
We covered that.
Yes. And in addition, inventory that is in transit at year-end, literally on a truck or a ship between a supplier and the company, or between the company and its customer, needs to be properly accounted for based on the shipping terms.
The shipping terms matter for ownership.
Critically, for example, if goods are shipped, FOB shipping point.
FOB?
It stands for free on board. FOB shipping point means ownership legally transfers to the buyer the moment the goods leave the seller's dock or warehouse.
So the buyer owns it even while it's on the truck.
Correct. So the buyer should include those goods in their year-end inventory count even if they haven't physically arrived yet. Think of it like ordering something online. If the terms are FOB shipping point, it's technically yours the moment it leaves the sender's warehouse.
Okay. And the alternative?
The alternative is FOB destination. In this case, ownership transfers only when the goods actually reach the buyer's specified location, like their receiving dock.
So the seller still owns it during transit?
Correct. The seller owns them until they reach the buyer's doorstep. Understanding these nuanced shipping terms, FOB shipping point versus FOB destination, is absolutely crucial to correctly determine who owns what inventory at the exact financial statement date, the cutoff point.
Wow. That's an incredible amount of layers and a truly granular level of detail.
Yeah.
It's clearly not just a quick count or a cursory check.
It's definitely not.
It's a deep, systematic dive into every single aspect of what that inventory number on the balance sheet represents. From its physical presence, its condition, its true ownership, right down to its accurate monetary value. It truly showcases the painstaking, methodical nature of auditing, ensuring that every number tells a verifiable story. Quite impressive.
It aims to provide that reasonable assurance.
Okay, so we've talked a lot about auditing the inventory balance, that snapshot in time. But beyond just checking that final balance, inventory also involves this constant flow of daily transactions, right?
Right.
Buying it, moving it internally, selling it, maybe returning it.
Absolutely. It's very dynamic.
How do all those continuous movements, those daily transactions, fit into the broader picture of the audit? Are they checked separately?
That's an excellent point about the dynamic nature. While our discussion on auditing the inventory balance really focuses on that crucial snapshot in time, what's physically there and properly valued on December 31st, for example.
Right, the year-end number.
The underlying transactions that build up or reduce that balance throughout the year are definitely audited, but typically as part of other interconnected audit cycles.
Ah, so not just within the inventory audit itself.
Generally, no. Specifically, inventory sales and the related cost of goods sold that gets recorded when something is sold are typically audited as part of the overall revenue cycle audit.
Mhm.
This ensures sales are legitimate, recorded accurately, and recognized in the correct period.
Okay, sales are part of revenue.
And inventory purchases, along with the costs of bringing that inventory in, like freight, are audited within the expenditure cycle or purchasing cycle audit. This verifies that all purchases are properly authorized, received, and correctly recorded as assets or expenses.
Purchases are part of spending. Got it.
So it's all interconnected. The audit procedures ensure that every significant movement of inventory in or out is properly captured and verified within the broader financial ecosystem of the company, looking at both the balance sheet, inventory asset, and the income statement, cost of goods sold.
Okay, that makes sense how it links together.
But this raises another incredibly important question for anyone trying to understand a company's financial health.
Yes.
Even if the numbers themselves are accurate and the transactions are all technically correct, is the overall financial picture complete and truly understandable to someone just reading those financial statements?
You mean, is the context clear?
Exactly. That's where presentation and disclosure comes in. It's all about how this complex inventory information, including its nuances and the underlying accounting policies the company uses, is communicated to the public. And this usually happens through the footnotes of the financial statements.
Ah, the footnotes. For many people, financial statements can look like just this daunting, impenetrable set of numbers, like a foreign language.
You certainly can feel that way.
But you've just highlighted the truth. The real story, the context, the critical details often lie hidden in plain sight, right there in those often overlooked footnotes, the disclosures.
They are absolutely crucial.
For inventory, these disclosures must be vital for anyone trying to truly understand a company's financial health, its operations, maybe even its risks. What exactly should auditors be looking for in these disclosures? And maybe more importantly, what should we, as listeners and informed users of financial information, be paying keen attention to when we look at them?
You've hit on a truly critical point that's often missed by the casual observer. The numbers themselves, as we said, are only ever part of the story.
Right.
The disclosures provide the essential context, the specific accounting policies chosen by management, and the additional details necessary for a user, an investor, a lender, even an employee to make informed decisions.
They fill in the blanks.
They fill in the blanks and explain the how and why behind the numbers. When auditing presentation and disclosure related to inventory, the auditor again uses those assertions we just discussed: completeness, valuation, rights, existence. But now they're applying them specifically to the notes and explanations provided alongside the main financial statements.
Okay, so how do those assertions apply to disclosures? Let's start with completeness again.
Okay, completeness disclosure. Here, the auditor must ensure that all required inventory-related information has actually been included in the notes to the financial statements. These aren't optional disclosures. These are specific pieces of information that accounting standards like GAAP or IFRS legally mandate must be disclosed because they are considered crucial for understanding the inventory position.
What kind of things must be disclosed?
Well, for example, a company must disclose its cost method. That is, whether it uses LIFO, last in, first out, FIFO, first in, first out, or maybe the weighted average method to determine the cost of goods sold and the value of ending inventory.
Can you briefly explain those again? Why does the method matter so much?
Sure. Imagine that bakery selling loaves of bread again and the cost of flour keeps rising.
Okay, inflation.
Right. LIFO assumes the last, most expensive loaves baked are the first ones sold. This results in a higher cost of goods sold expense on the income statement and therefore lower reported profits during periods of rising prices. Ending inventory on the balance sheet, however, will be valued at the older, cheaper costs.
So LIFO, lower profit, older inventory value in inflation.
Generally, yes. FIFO, first in, first out, assumes the first, oldest, and likely cheaper loaves baked are the first ones sold. This often leads to a lower cost of goods sold and therefore higher reported profits during inflation. Ending inventory will be valued closer to the current higher replacement costs.
FIFO, higher profit, newer inventory value in inflation.
Correct. And weighted average just takes an average cost of all the loaves available during a period. As you can see, the choice of method can significantly impact reported profits and the asset value shown on the balance sheet. So, knowing which method a company uses is absolutely vital for comparing that company to its peers or understanding its true profitability trend. The disclosure is essential.
Okay, the cost method is a big one. What else must be disclosed?
They also must disclose their specific valuation method, typically. This means stating that inventory is valued at the lower of cost or market or lower of cost and net realizable value.
You mentioned that earlier, the conservative approach.
Exactly. Lower of cost or market, or its newer equivalent, lower of cost and net realizable value, is that conservative accounting principle. It basically says if the market value or the expected selling price, less cost to sell, of your inventory falls below what you originally paid for it, its cost, you must write the inventory value down on your books to that lower market value or net realizable value.
Preventing companies from carrying inventory at inflated values.
Precisely. It prevents companies from overstating their assets when inventory has lost value due to damage, obsolescence, or market price declines. Disclosing that they follow this rule provides assurance.
Okay. What other required disclosures?
Other required disclosures typically include the breakdown of inventory into its major components: raw materials, work in process, and finished goods inventory balances. Seeing these separate balances shows the different stages of inventory within the company and can offer insights into its production cycle efficiency or potential bottlenecks.
See how much is ready to sell versus still being made.
Right. Details about consigned inventory are also required, explicitly stating if the company holds significant amounts of others' goods, which aren't included in their inventory number, or if significant amounts of its own goods are held by others, which are included. Clear disclosure avoids confusion about ownership.
Makes sense. Any others?
Yes, importantly, if inventory has been pledged or assigned, meaning it's been used as collateral for a loan, maybe to secure financing.
Like putting the inventory up against a debt.
Exactly. This must be clearly disclosed in the footnotes. Why? Because it means someone else, a lender, has a claim on that asset if the company defaults on the loan. Investors and other creditors need to know that.
Yeah, it's crucial information.
Absolutely. Also, any significant losses from inventory write-downs may be due to a major product recall, a fire or flood that damaged stock, or sudden mass obsolescence should be disclosed. And similarly, significant purchase commitments.
Purchase commitments, what are those again?
That's where the company is contractually obligated to buy a certain amount of inventory in the future, perhaps at a fixed price. If market prices fall or demand drops, this commitment could become unfavorable. Imagine a company that committed to buying a huge quantity of a specific microchip, but then demand for their end product suddenly plummeted. That commitment is a significant future obligation or potential loss that needs disclosure.
Okay, got it. Like being locked into buying something you might not need.
Exactly. And finally, information about warranty obligations, if the products sold come with warranties, needs to be explained. These represent a future liability, the estimated cost of fixing or replacing defective products that's directly tied to past sales of inventory. So, ensuring all these required pieces are present addresses the completeness assertion for disclosure.
That's a lot of required information in those notes.
It is, and it's all vital for a full understanding.
Okay, so what about the other assertions for disclosure, like valuation or rights?
For valuation, allocation, and accuracy disclosure, the auditor's procedure is primarily to meticulously read the footnotes and any other narrative information related to inventory presented alongside the financial statements.
Just reading it carefully.
Reading it carefully with a critical eye. They do this to determine whether the information presented is accurate, makes sense, is presented at the appropriate amounts, and aligns with the numbers and events they audited elsewhere. This ensures that the descriptive text in the notes doesn't contradict the numerical values in the main financial statements or the actual economic reality found during the audit. The words have to match the numbers and the facts.
Making sure the story told in the notes is consistent and accurate.
Exactly. Then, regarding rights and obligations and occurrence disclosure, the auditor ensures that all inventory-related obligations, like that pledged inventory we talked about, have been properly disclosed, and that the disclosed information, like the details of a purchase commitment, actually occurred or is legitimate.
How do they check that for disclosures?
This involves inquiring of management specifically about any pledged inventory, and then corroborating that by reviewing key legal documents like loan agreements and board of directors meeting minutes for any evidence that inventory has indeed been pledged or assigned as collateral.
Looking for the legal proof?
Yes. They also inquired about warranty obligations and how those are estimated and disclosed. And a critical step here is to compare these disclosures to all other audit evidence gathered throughout the entire audit during the physical count observation, the test counts, the transaction testing. They ensure complete consistency and truthfulness.
So tying it all together.
Tying it all together. What's said in the footnotes must definitively match what was found and verified in the actual painstaking audit work performed elsewhere.
Okay, and the last one, understandability.
Right. Finally, for understandability of presentation and classification disclosure. This is about clarity. The auditor reads all the inventory-related disclosures very carefully to ensure they are, well, understandable. Clear, concise, and reasonably easy for an ordinary user, someone who might not have a deep accounting background, to grasp.
Avoiding confusing jargon.
Exactly. Avoiding overly technical jargon where possible, or clearly explaining it if it's necessary. They also review the inventory classifications used in the disclosures, and on the balance sheet, the breakdown between raw materials, work in process, and finished goods, making sure items are categorized correctly according to their actual stage of production or readiness for sale.
Making sure things are labeled correctly and clearly.
Correct. This prevents a user from misinterpreting a company's operational status or financial health based on poorly classified or confusingly presented inventory information. It's about making the communication effective.
That's incredibly thorough.
Yes.
And it really highlights how much goes into those financial statements beyond just the final figures we see on the page. So it's not just about the numbers themselves. It's crucially about how they're presented and explained in a way that gives you, the user of this vital financial information, the full, clear, and absolutely accurate picture. It truly makes you appreciate the layers of scrutiny involved.
It's designed to build that confidence and trust in the numbers.
Wow, what an exhaustive deep dive into the inventory cycle. We've truly unpacked, I think, just about everything. From those foundational internal controls, segregation of duties, purchase orders, blind receiving counts that act as the company's first line of defense against fraud and error,
The bedrock.
to the incredibly meticulous steps auditors take to independently verify inventory, observing counts, test counting, checking valuation, confirming ownership,
The verification layer.
and finally how all of this crucial information is presented to you, the informed public, in a clear and understandable way through those vital disclosures in the footnotes.
Bringing it all together.
We really hit on some of those aha moments too, didn't we? Like why the receiving department gets a purchase order with a hidden quantity, that brilliant, subtle control.
A classic control technique.
And that subtle but critical difference that auditors observe inventory counts rather than doing all the counting themselves.
A common point of confusion, clarified.
And of course, the immense, often underestimated importance of reading those footnotes in financial statements to get the real story.
Absolutely. The footnotes are where the details live. If we connect this to the bigger picture, truly understanding the inventory cycle, which encompasses both the company's internal operational efficiency and the external audit process. It reveals just how much sophisticated effort goes into ensuring that financial statements are reliable.
A massive effort.
It really highlights this intricate dance between a company's commitment to robust internal processes, its operational efficiency trying to manage these assets well, and its unwavering obligation for transparent reporting to the outside world. Ultimately, it really underscores the very bedrock of trust that these complex systems aim to build and maintain within our global economy.
Absolutely. That trust is fundamental. So next time you glance at a company's financial report, or maybe even just walk into a store and see those perfectly stocked shelves, take a moment to consider the incredible, largely unseen system of controls and checks that ensures those products are actually there, that they're valued correctly, and that every single item ideally is accounted for. What does that complexity tell you about the vast, intricate layers of trust built into our global economy and the continuous effort required every single day by countless people just to maintain that trust?
It's a fascinating thought, isn't it? The hidden machinery behind it all.
It really is. Thanks for joining us on this deep dive today.